Most investors assume that if a financial crisis begins, it will start on Wall Street, in a major bank, or somewhere deep inside the global bond market. But what if one of the earliest warning signs is emerging from a market that rarely makes front-page headlines? A market built around a metal that is essential for solar panels, artificial intelligence infrastructure, military technology, electric vehicles, electronics, and thousands of products that modern civilization depends upon every single day. Silver. In recent months, investors around the world were stunned when a major Chinese silver fund suspended trading after premiums surged far above the value of its underlying assets. The fund manager warned that the premium had become unsustainable, highlighting just how intense investor demand had become. What appeared on the surface to be a niche event inside China's commodity markets may actually reveal something much larger happening beneath the global financial system. At the same time, a deeper question is beginning to emerge. Why are people suddenly rushing towards silver? And why have three assets managed to survive every empire, every currency collapse, every debt crisis, every war, and every financial experiment across more than 5,000 years of recorded human history? Gold, silver, and productive land. Empires have disappeared, currencies have vanished, governments have defaulted, entire financial systems have been reset. Yet these assets remain. Here's what's really happening behind the headlines. Most investors are looking in the wrong place. Few people understand the chain reaction that could unfold as industrial demand, monetary uncertainty, geopolitical competition, and resource constraints begin colliding simultaneously. In this video, we're going to examine 6 critical insights. Why the Shanghai Silver Fund suspension matters. The hidden supply challenges facing the silver market. Why demand is changing faster than many analysts expected. What history teaches us about periods of financial uncertainty. Why governments, institutions, and sophisticated investors are paying close attention. And finally, what ordinary people should understand about protecting purchasing power in an increasingly uncertain world. Because this story is much bigger than a silver fund. It's about how the world is changing, and what that change could mean for all of us. The immediate headline was simple. China's only major pure-play silver futures fund temporarily halted trading after investor demand pushed the market price dramatically above the value of the silver exposure it actually held. In some cases, premiums climbed well above 30% and even exceeded 60% during periods of intense speculation. Fund managers repeatedly warned investors that these valuations were disconnected from underlying assets and carried significant risks. But here's what most people don't realize. The suspension itself was not the story. The premium was the story. Let me explain this with a simple analogy. Imagine a bottle of water that normally sells for $1. Suddenly, people begin paying $2, then $3, then $4. Eventually, people are no longer buying the water because they need water. They're buying because they're afraid they won't be able to get it later. That's when markets start sending signals. Think of the global economy like a machine. Silver sits inside countless gears of that machine. When investors become willing to pay extraordinary premiums for silver exposure, it often indicates concerns extending far beyond a single commodity. It can reflect worries about inflation, concerns about currency purchasing power, expectations of future shortages, or fears that industrial demand may outpace available supply. Mainstream media often treats these events as isolated episodes of speculation. But experienced commodity investors tend to ask a different question. What conditions made investors so eager to own silver in the first place? If you're interested in understanding the forces shaping precious metals and the global economy, consider subscribing. I post videos like this regularly. To understand why silver continues attracting attention, we have to examine the supply side. Many people assume mining companies can simply increase production whenever prices rise. Reality is far more complicated. Imagine trying to fill a swimming pool while someone keeps turning off the hose. That's a useful way to think about the silver industry. Most silver isn't actually mined from primary silver mines. A significant portion comes as a byproduct of mining operations focused on copper, lead, zinc, and gold. That means silver supply often depends on economics occurring elsewhere in the mining sector. Even when silver prices rise, production cannot always respond quickly. New mines require years of permitting, financing, infrastructure development, environmental reviews, and construction. Meanwhile, ore grades have generally declined across many mining regions. Miners must process larger amounts of rock to produce the same amount of metal. That increases energy consumption and operating costs. Countries such as Mexico and Peru remain among the world's largest silver producers, while nations like China, Russia, Chile, and Australia play important roles across broader mining supply chains. Political uncertainty, resource nationalism, environmental regulations, labor disruptions, and energy costs can all affect output. Mining is ultimately an energy business disguised as a metals business. Without affordable energy, extracting metal becomes increasingly expensive. And as the world pursues electrification, renewable energy expansion, and technological modernization, the demand for raw materials continues growing. The challenge is that new supply often arrives much slower than policymakers expect. That imbalance matters. Because commodities rarely care about forecasts. They care about physical reality. And physical reality can be stubborn. The demand side may be even more fascinating. For centuries, silver was viewed primarily as money. Today, it occupies a unique position. Silver is both a precious metal and an industrial metal. That combination makes it unusually important. Every solar panel requires silver. Advanced electronics require silver. Electric vehicles require silver. Medical equipment uses silver. Defense technologies depend on silver. Telecommunications infrastructure uses silver. Artificial intelligence data centers require enormous amounts of electrical equipment and connectivity hardware that rely on silver's exceptional conductivity. This creates a fascinating dynamic. Gold demand is often driven by monetary concerns. Silver demand is influenced by both monetary concerns and industrial growth. In other words, silver can benefit from two entirely different forces simultaneously. When economies expand, industrial demand can increase. When financial uncertainty rises, investment demand can increase. That dual role is one reason silver markets can become surprisingly volatile. Recent years have witnessed growing demand linked to solar deployment, electrification, digital infrastructure, and advanced manufacturing. Analysts continue debating future deficits, but many agree that industrial consumption is becoming an increasingly important component of the silver story. If this analysis is helping you connect the dots, subscribe and join our growing community here at Precious Metals Alert. History rarely repeats perfectly, but it often rhymes. Consider the 1970s. Inflation accelerated, energy prices surged, confidence in monetary systems weakened. Investors searched for stores of value. Precious metals responded dramatically. Fast forward to 2008. The global financial system experienced severe stress. Central banks intervened aggressively. Interest rates collapsed. Confidence in financial institutions was shaken. Again, precious metals attracted attention. Then came the COVID era. Global supply chains fractured. Factories shut down. Shipping networks struggled. Governments launched enormous fiscal and monetary stimulus programs. Many assumptions about economic resilience were suddenly challenged. What connects these periods? Uncertainty. Whenever uncertainty rises, markets begin reassessing risk. Investors start asking different questions. What is truly scarce? What holds value independently of financial promises? What survives when confidence weakens? That's why gold and silver have repeatedly reappeared throughout history. Not because they are magical, not because they guarantee wealth, but because they are tangible assets with long records of maintaining relevance across different economic systems. History teaches another important lesson. Shortages rarely appear overnight. They develop gradually, then suddenly become obvious. The people who recognize trends early often appear overly cautious at first. Later, their concerns can look remarkably reasonable. That's one reason serious investors study history, not to predict the future with certainty, but to understand recurring patterns. Today, sophisticated capital is paying close attention to those patterns. Around the world, central banks have increased interest in tangible reserve assets, particularly gold, as governments navigate rising debt burdens, geopolitical tensions, and concerns about long-term currency stability. Organizations such as the International Monetary Fund, the World Bank, and the World Gold Council continue monitoring these shifts closely. Why does this matter? Because debt levels across many developed economies remain historically elevated. Government deficits continue expanding. Interest costs are consuming larger portions of public budgets. At the same time, emerging powers within the BRICS grouping have explored alternatives to excessive reliance on the US dollar-centered system. None of this means the dollar is about to disappear, but it does mean nations are increasingly focused on diversification. Family offices, institutional investors, sovereign entities, and long-term capital allocators understand a simple principle. Concentration creates vulnerability. Diversification creates resilience. That principle applies to nations, it applies to corporations, and it applies to households. If you're finding value in these deeper macro insights, consider subscribing because we cover the stories mainstream media often overlooks. Ultimately, this discussion isn't really about silver. It's about purchasing power. It's about savings. It's about retirement security. It's about understanding the forces shaping the world around us. No one can predict the future with certainty. Anyone claiming certainty about future silver prices, future inflation rates, or future economic outcomes should be approached carefully. But understanding the forces at work allows people to prepare rather than react. That's the key distinction: preparation versus reaction. The three assets that have demonstrated extraordinary longevity throughout human history are gold, silver, and productive land. Each possesses characteristics that have repeatedly mattered during periods of economic change. Scarcity, utility, durability. They are not perfect. They experience volatility. They go through long periods of underperformance, but they have survived every monetary system humanity has created. For ordinary people, the lesson is not to bet everything on one asset. The lesson is diversification, long-term thinking, risk management, patience. Financial resilience is rarely built through dramatic predictions. It is usually built through consistent decisions made over many years. And perhaps that is the most important takeaway from all. The suspension of a Chinese silver fund may seem like a distant event affecting a small corner of global finance, but it highlights something much larger. When investors become willing to pay extraordinary premiums for exposure to a tangible asset, markets are often signaling underlying tensions that deserve attention. We've explored how supply constraints can develop slowly over time. We've examined growing industrial demand from solar energy, electrification, advanced manufacturing, and digital infrastructure. We've looked at historical periods when uncertainty altered investor behavior. And we've discussed why governments, institutions, and sophisticated investors continue monitoring precious metals and real assets. The broader lesson extends far beyond silver. Civilizations change, technologies evolve, currencies come and go, financial systems are redesigned, yet the fundamental laws governing scarcity and value remain remarkably consistent. Markets move in cycles, headlines come and go, but the laws of supply and demand never disappear. Whether silver ultimately experiences shortages, surpluses, rallies, corrections, or years of sideways movement, the underlying forces shaping the market deserve serious attention. Pay attention to the trends most people ignore, because sometimes the biggest opportunities emerge long before the crowd notices. If you found this analysis valuable, please like the video, subscribe to Precious Metals Alert, and share it with someone who wants to understand the changing world around us. Until next time, stay informed, stay prepared, and keep your eyes on the metals.